Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. 100 days down, 1,361 to go. Trump's return to the White House is already reshaping the global order, sending shockwaves through financial markets. Asset prices have tumbled, correlations have fractured, and investors are reassessing risk itself.
Who better to help us make sense of the turmoil than Financial Times columnist Katie Martin? And in today's dumb question of the week, is this a good time to be a financial journalist? Today we're delighted to be joined by Katie Martin from the Financial Times. Katie writes the Longview column, unpicking the latest market trends, and co-hosts the Unhedged podcast. And of course, is a reliable source of sanity and sarcasm amongst the noise. Thanks so much for joining us, Katie.
Pleasure.
So in the 3 months since Trump took office, he's unleashed a trade war, alienated allies, and led markets to question the safe haven status of US debt and the dollar itself. Katie, how surprised were you by the emergence of this Sell America trade?
Yeah, as you say, he's got a lot done in his first 100 days. It's been really something. I mean, I didn't think we would be where we are now at this point, and I don't think the professionals in markets did either, right? So, if you look at all the kind of notes that we had at the back end of last year from the big investment banks, from the big investment houses saying this is what we expect from 2025, this is what we expect from Trump, it was not this. It was American exceptionalism, so US stocks beating the rest of the world hands down. It was a stronger dollar because tariffs were thought to be inflationary. It was just this kind of buy America thing. And that has flipped completely on its head in the course of 100 days to actually, as you say, I'm worried about the safe haven status of the dollar. I'm worried about US government bonds in a way that I haven't ever been before. And Europe is beating the US hands down. So it's a massive surprise for everybody, I think.
And so do you think that there's any kind of bid for European assets, including things like gilts now that US treasuries aren't looking so cool?
Yeah, so on the question of treasuries, look, there's a lot to unpack there. There is definitely a groundswell of opinion among big money managers that Trump and his administration, by hinting at this idea that they might impose some sort of terms and conditions to US Treasury holders, that does blow apart a good part of the trust element that makes treasuries do what they do, which makes them act like this safety valve for the entire financial system. So the question then is, for fixed income managers, for bond managers, where does that money go instead? Now, for years and years, the argument has been there is no way that the dollar could be unsettled from its role as the dominant global reserve currency, and there is no way that treasuries could be shunted aside from this crucial role because there is no alternative. No other bond market can accommodate this flow. And look, to a large extent, that remains kind of true. There is no other bond market on earth that's a single country bond market that simultaneously offers the safety and size and depth and liquidity that treasuries offer. But what there's also never been before is such an urge to find an alternative. The alternatives have always been there, but no one's ever really bothered to jump into them because why? Treasuries already do the job. Inertia is a thing. Let's just stick with treasuries. So where does the money go instead? Some of it, I would imagine, would go towards gilts, but gilts are a bit of a weak link in the sort of developed market fixed income universe. So currently where a lot of the money is going is into things like German bunds.
Does it help that they're going to issue way more of them potentially in the future?
Massively. So there was a huge drop in German government bond prices earlier this year when Germany said, okay, we're going to issue lots more bunds because we've decided, finally, we've been telling them this for God knows how long, we've decided we need to spend some money. And so there was a big drop in German government bond prices, but at the same time, there was a big jump in the euro. So this was not the market's way of saying, oh no, we think Germany has become fiscally incontinent, because that's just stupid. That just doesn't bear any kind of scrutiny at all. But since Trump has started doing what he's doing with the tariffs and with geopolitics more broadly, we've seen that the yields on German government bonds come down really quite hard. So they've picked back up in price a lot. So there's clearly demand, a lot of demand for German paper, even though there's a lot more of it kicking around.
I mean, I guess if it is going to be a viable alternative to the dollar and to treasuries, there needs to be more of it, right? You need that depth of the market,
Yeah.
Especially if they're not going to issue common European debt at scale.
Well, are they not going to issue common European debt at
Well, let's
scale?
see,
I
right?
mean, I feel like the Eurocrats understand the assignment here, right? They can see the opportunity that's in front of them. They are not idiots. They can see that, and they want to have a much more important role in terms of reserve currency status. So this is a thing that they want, and it's a thing that they can see that the market wants in a way that perhaps it hasn't before. You know, the EU has done joint issuance before, you know, some of it 5 years ago around COVID, and the market bit their hand off. And now they could not fail to sell this paper. I'm absolutely convinced of it. There is a huge groundswell of demand for joint European paper. Maybe I'm reading too much into it. I'm not a kind of EU Kremlinologist, but I feel like the fact they've gone really quiet about this stuff says to me they're working on something. So purely a hunch, but I feel like they will make this work somehow and they will fudge it. This won't be a perfect debt instrument, but if the EU is good at anything, it's good at fudging stuff under pressure. And I feel like that is the job that's in front of them.
It's certainly for things like defence, it seems as if this common issuance is something they're considering.
Yeah.
But what's interesting to me is all of the other consequences of Trump's policies, which is you look at the Canadian election, you look at what's happening in Europe with greater unity, I'd say, almost kind of a revitalisation of Europe. What other consequences do you think there are going to be as a result of the fallout?
I experience something quite odd, which is when I speak to US asset managers, the vibe is very much, look, this is a total mess and this is awful and there's a lot of volatility and there's a lot of very unpleasant market moves, but this too shall pass. Don't worry, we'll get over it. We'll get back to being the world's dominant market. When I talk to people in Europe, they're like, nah, something very fundamental here has changed. And the starting point for a lot of European asset managers is not even the tariffs, which were, you know, the Liberation Day tariffs were announced on April the 2nd. You go back a few weeks from that, it was JD Vance in Munich.
Yeah.
It was, you know, he rocked up to the sidelines of he rocked up to the Munich Security Council and started praising the far right in Germany and started lecturing Europe about free speech. This went down like a cup of cold sick. The Europeans are deeply offended by this. And for them, that just says, okay, the US is just not the ally that we thought it was. And that's not the only kind of broadside against Europe that's come from the administration by any stretch of the imagination. And so for a lot of European asset managers, that is a really important moment. So do I think that European asset managers en masse are going to dump all of their US assets? No. Do I think they're going to accumulate more US assets? Not at the speed that they previously did. I think there is a big pivot going on. And I think, you know, the fast money is already on this. The hedge funds are all over it. Your kind of CTA traders, you know, even quite a lot of retail traders, they're already on this. But the really kind of big super tanker here is real money, right? It's pensions, it's insurers, it's all of those guys that they don't just dart in and out of markets just for fun. They have meetings about maybe tweaking asset allocation, you know, every kind of quarter. They are much more slow moving. And I think we're just at the very beginning of that process where they realign much more closely towards domestic investment, towards European investment, and Asia, actually, for that matter, and just pivot away from the US because the world has finally realized that accidentally it's massively overweight US. This was not really the plan.
And I guess you could say that the US was looking potentially quite overvalued anyway coming into this. So it didn't need a huge shock to ruin it. And we had a huge shock anyway.
Yeah, the US market was absolutely priced for perfection. And this is not perfection. I think that is a reasonable assertion. The other kind of element here is, again, the world had found itself massively overweight US. It had also found itself massively overweight US tech in particular. And a massive challenge to US tech has come along in the form of DeepSeek from China. So turns out China can build actually pretty decent AI widgets at a tiny fraction of the cost. And that blows apart a big chunk of the investment case for all of the big, shiny, big tech names in the States that are trading at God knows what kind of multiples to their earnings. So that's a double whammy in effect. You've got the geopolitics and the tariffs, which are kind of a piece. And then you have this notion that actually US big tech does not necessarily have the moat around it that we previously thought. That's not a great combo for US stocks.
So do you think that with all the noise in the flooding of the zone, as they call it, with Trump, is there anything going on in markets which people have kind of ignored?
It's a good question because this is the only story in town. It's the only game in town. I feel like actually a lot of this DeepSeek stuff, a lot of the challenge to US tech dominance is getting a bit drowned out in the tariff noise. China, as I'm sure you know, the market shifts, ebbs and flows between it's uninvestable to we love it to it's uninvestable again.
I think we've gone there and back in the last 3 years a few times on our podcast.
Yeah. You know, just when you feel like you're comfortable, there's some new regulatory thing or strategic thing that kind of blows it out of the water. But I think investors are willing to look at China in a way that they haven't been for the past few years. That said, the potential hit to the Chinese economy from the tariffs, I don't think it's going to be as big as certainly Donald Trump thinks it will be. I think China can wear this somewhat better. I think they're actually holding quite a lot of the cards here. But I think that is something that is considered to be investable and is definitely worth keeping an eye on.
And do you think the fact that the US is stepping back from the world stage, for example, closing embassies in Africa, that's really leaving room for countries like China to step in and become more dominant on the world stage and just seeming like a much more reliable partner?
Yeah. I mean, China, Russia, not necessarily the most pleasant regimes on earth, but you know what you're getting. The US is clearly squandering its leadership role, whether that is in geopolitics or whether that is in finance. And the consequences of that will continue to be felt for a long time because my sense is there's no way back from this. You know, once the trust is gone, it's very difficult to move past it. So I don't see an easy way that the US can click its fingers and say, okay, Trump's out of office now, or, you know, we've had another set of elections, you know, whatever it is.
Let's hope so.
Let's all just pretend that that didn't happen. I don't think the world is looking to pretend that didn't happen anytime soon because for long-term asset managers, people who think in chunks of 30, 40, 50 years, we can't do this every 4 years. We just can't. Like, our nerves are not built for it.
I think it would be a different thing if we actually knew what the Trump administration wanted out of the trade war, right?
Yeah.
If Europe could go to the administration and go, okay, these are their demands, we can see a landing zone in the middle, rather than just this sort of vague thing where you don't know who you're speaking to. Is it Scott Besson? Is it Lutnick? Is it Trump himself? And they're like, what can you offer us?
Well, I think that, you know, the Wall Street Journal had some good reporting about that. You know, the Japanese delegation turned up in the States to talk about a trade deal, and they sat down in front of the US representatives and said, okay, what do you want? And they didn't have an answer.
No.
So how do you negotiate with that? And, you know, for one country, it's apparently about fentanyl. For another country, it's apparently about immigration. We've spent quite a lot of time and energy at the FT trying to figure out, okay, what's the framework here? What is the overarching worldview? What are we dealing with? And actually, we're coming to the quite uncomfortable conclusion that there really is no plan. And the lack of the plan is not a strategy. Chaos is not a strategy. The strategy is not a strategy. So it's just a big mess. And so, yeah, if you're trying to negotiate a trade deal with this administration, what do you offer?
I mean, it seems that the US administration is kind of negotiating within itself to try and
100%,
find out
yeah.
what they want.
There's also some fun reporting around, I think again it might be from the journal, that obviously there was the big climb down from Trump over the Liberation Day, quote unquote, bunny ears, Liberation Day reciprocal tariffs. And the reporting around that is that literally Scott Bessent and Howard Lutnick, the Commerce Secretary, waited until Peter Navarro was in a different part of the White House.
Yeah, lock the door.
I'm not exaggerating. This is the reporting. Went into the Oval Office, convinced Trump to take a quote unquote pause, got him to send out the post on Truth Social saying I'm pausing, and then scarpered. So Navarro heard about it at the same time as everybody else. And this is just no way to run an economy, is it? So how do you negotiate with that framework? I really no clue. If the Brits say, okay, fine, we'll take your chlorinated chicken and you can have a big tournament at your golf course, whatever it is, will that move the dial? And does the administration have the bandwidth, the capacity to renegotiate hundreds of trade deals within 90 days? I mean, we're at 15-ish days in. None have been signed so far.
And even if you sign one, right? I mean, Trump signed one in his first term with Canada and Mexico, and now he's trying to throw it away. So what are you even signing?
He literally signed the USMCA. So the kind of Canada, Mexico, US trade deal, his ink is on that piece of paper. It's not worth the paper it's written on. And one of the really kind of interesting things that for Main Street America, I think there's a lot of people that have not yet felt the impact of what is going on. There's a couple of reasons why they're going to quite soon. One is tourist numbers to the US have cratered. I mean, I'm not in a hurry to go to the US for business or pleasure. I don't know about you guys, but I'm not going near the place.
We joked the other week that we'd have to delete every episode of our podcast before we do.
Yeah, I mean,
lest we end up in some South American prison.
I don't particularly want to go to El Salvador, thanks very much. So I'm not in a hurry to go to the States. The other is, I don't know if you've seen the numbers around arrivals of cargo at major ports in the US. Those ports are empty. Because 145% tariffs on China effectively means no trade with China.
Yeah, it's an embargo by any other word, really, isn't it?
Exactly. So people are going to start seeing empty shelves really quite soon. And actually on that point, that to the extent that we are all grappling around for some sort of strategic or intellectual framework for what the administration is doing here, maybe isolating China, that's the result. Whether it's the intention or not, I don't know, but that's the result. And it forces the rest of the world to make a decision. Whose side are you on?
Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Trading 212 Stocks and Shares ISA is the cheapest way to invest, with zero commission and the lowest FX fees I could find on the market. Looking to keep things simple? You can easily automate your investing with pies that allow you to rebalance your portfolio at the click of a button. Customers with Invest accounts can also benefit from the Trading 212 card, which has no FX fees, true interbank rates, and offers 0.5% cash back on all transactions up to £20 per month. Many Happy Returns listeners can claim free fractional shares worth up to £100. Just create and verify a Trading 212 Invest or Stocks ISA account, make a minimum deposit of £1, and use the promo code RAMIN, RAMIN, within 10 days of signing up, or use the link in the show notes. When investing, your capital is at risk and you may get back less than invested. Past performance doesn't guarantee future results. Pies and Autoinvest is an execution-only service, not investment advice or portfolio management. Automatic investing refers to executing scheduled deposits. You're responsible for all investment and rebalancing decisions. Free shares can be fractional. 212 cards are issued by Paynetics, which provide all payment services. Trading 212 provides customer support and user interface. Terms and fees apply. It's interesting listening to you and Robert Armstrong, Rob, talking on your podcast about what's going on in America. And he's very much from the camp that this is a temporary thing, whereas you're a bit less sanguine, I'd say, about the upside. I mean, if you just look at the polls right now, it doesn't seem as if it's really a huge fall of popularity for Trump, given what's happened in terms of markets, in terms of the economy.
Yeah.
Do you think that there'll be another Trump? Will there be an appetite for more populism after Trump? Because that's my big worry, whether this continues after the 1,300 days.
Yeah, it's a really good question. And I think the Americans don't understand how cross the Europeans are. But also, I think we Europeans don't understand the US media landscape. There's a huge proportion of the population in the States that has no idea any of this is happening. If you switch on Fox News, this is not the story of the day. When the markets were cratering a couple of weeks ago, they took the little chyron off the bottom of the screen that says this is what the markets do. It's kind of, Soviets putting Swan Lake on the telly kind of level stuff. They just pretend it's not happening. So there's a lot of people that don't realize. So that's why I say it's so important that within the next few months, they're going to see stuff disappearing from shelves. So there's a note kicking around that's getting quite a lot of attention at the moment from like the American Toy Association or something like that. And they're saying, the vast majority of toy retailers in the US are relatively small businesses. 50% of them say they're going to go out of business if these China tariffs actually come through at those sorts of levels. Christmas is cancelled. The cargo is not arriving. The toy shops are going out of business. So it's going to have to, I think Americans need to really feel this before they can come round to any kind of analysis over whether this was a good idea or not.
I mean, Scott Bessent, the Treasury Secretary, has said explicitly that this tariff situation with China is unsustainable now. I mean, he's probably the most moderate, if you want to put it that way, in the administration. But is there an off-ramp here with China? And what is it?
Yeah.
If they're waiting for China to blink, I think they might be waiting a while.
That's the thing. And again, there's been a lot of insults thrown around. So one thing that annoyed a lot of Chinese officials is when J.D. Vance referred to the Chinese population as a bunch of peasants. Like, okay, that's an interesting place to start your negotiations. Where is the off-ramp? I don't know. And to what extent is Scott Bessent holding back the president? We just don't know. I'm old enough to remember that, Treasury Secretary said something was going to happen, and you could take that to the bank. This was a fact. This is the Treasury Secretary speaking. Yeah. He's in charge of this stuff. Now we're just not living quite in that world.
I mean, people are looking around for an adult in the room, right? And they're like, well, Scott Bessent, he's at least a teenager there. He's got something going for him.
I think he gets it, but ultimately he needs to stay on board with Trump, and that means saying some things that you think, does he really believe this? So he was on the sort of Sunday TV circuit just last weekend, and he was asked, Trump is saying he's got 200 deals already struck on the tariff renegotiations. What's he talking about? And Bessent sort of looks a bit slightly like a rabbit in the headlights, which I think he always does anyway, and says, well, I think what the president is referring to here is sub deals. Yeah. What now? That's one of the other really interesting things that I think has happened to markets over the past 100 days is that we just question everything. So you see the Treasury Secretary say something and you're like, does he really mean that? Or is he just saying it because he wants to stay on board? And then, you have markets acting rather strangely ahead of announcements from the White House about tariff delays and whatever. And people say, well, is this insider trading? I have no idea. But I do know that it's bad that trust in markets has deteriorated to the point that that's the question people ask whenever an announcement comes out from the White House. So we're in a very unusual place here. It's not comfortable territory.
And where do you think we might be going? I mean, at the moment, things are not quite as bad as they were when we had the widespread tariffs. There was a stepping back from that. Do you think it could get worse from here?
My personal view is, yes, it can get a lot worse, but there is a school of thought that's not insane, that is, look, buy the dip. He's backing down. He's backing away from his attacks on Jay Powell, the chairman of the Federal Reserve. He's backing down from his tariffs because he can see how damaging they are, not just to stocks, but also, more importantly, to the bond market, which he described as getting a little yippy.
Yeah, he was right on that. It was yippy.
Yeah, it was yippy. It was a little nauseous, I think was another phrase he used. Anyway, so he does step back when he has his the flame to his feet. So maybe the case for buying the US, not necessarily for US exceptionalism, but for staying invested in the US, maybe that still makes sense. I'm sympathetic to that, but I do also think that it's actually when the markets are relatively quiet and they're doing relatively well, that's arguably when we should be the most worried, because that's when he might think to himself, okay, this was fine. I'm going to try it again. I'm going to see how far I can push this. Again, how effective is Scott Bessent? It's difficult without being in the room to really judge, but I certainly wouldn't fall off my chair with surprise if it was him that talked Trump down from some of the attacks he's been leveling against Jay Powell recently, because that really is third rail stuff. You don't muck about with the Fed. The market does not like that at all.
Yeah, if you're talking of things getting worse, it seems there's a few routes, isn't there? There's going after the Fed. That would be a huge change.
Yeah.
There's escalating the trade war into sort of capital controls that go along with it. That would be scary.
Yeah, there's a number of ways he can make this worse. Again, I find it odd when, in a sense, when people say, "Oh, well, he's back down." It's like, yeah, but he could back up again with a click of a finger. Like, someone who's that prone to changing their mind can change it in either direction at any time. So I'm not sure why people take as much comfort as they do from these little step backs. I think the big picture, the sort of grand sweep of history here, is that people have woken up to the fact that global stocks indices are between 60 and 70% weighted to the US. And that's fine as long as the US is a functioning ally and liberal democracy that obeys the rule of law. But it's less fine when any of those things is undermined. So people have been talking about market concentration for a long time. Now they're really starting to act on it.
I mean, having said all of that, you said Liberation Day, as Trump called it, was the 2nd of April?
Yeah.
So we're like a month on. It's conceivable that the S&P 500 will end April flat, which seems kind of weird, right?
Yeah, it is. But stocks, for me, are not really where the action's at. The really important thing to watch is treasuries and the dollar. That's a much bigger signal. Yes, April might end up being flat. I mean, honestly, what a world. But the fact that when the tariffs hit the fan on April the 2nd, the fact that treasuries went down rather than up, that's not a great sign, especially when you've got the dollar selling off at the same time. So for me, that relationship snapping, that correlation snapping, that use of the dollar as a haven asset and of treasuries as a haven asset, that's quite dark. And that's not a positive signal for US equities.
I mean, the dollar weakening at the same time as treasuries and the US stock market, if anything, is going to push international investors out of the US equity market. Is that right? I mean, you don't want the dollar going down at the same time.
Yeah, I mean, Trump and Bessent actually are very keen to throw focus on the scale of the recovery in US stocks after Trump's step back. But that's quite disingenuous, right? It overlooks how big the shock was. And I think certainly Bessent knows full well that treasuries are really where the action's at. And actually, Trump's step back, his pause on the so-called reciprocal tariffs, it doesn't feel like coincidence to me that it came a couple of days after a really quite nasty auction of 3-year US government debt. The usual kind of overseas buyers just did not show up. And Bessent knows, he surely knows, he's done his time in the sort of hedge fund world. He knows that's bad. And I feel like that was a big part of Trump's decision. That's the yippiness that he was talking about, to reel back. So in a way, that is the bond market showing its teeth a little bit. Yes, it was a 3-year, blah, blah, there are all sorts of caveats and yes buts, but they hold a lot of power here.
I know you don't like talking about the Mar-a-Lago project, but one of the things they were talking about was century bonds. Now, the idea here is obviously if you're Japan, if you're a big holder of US treasuries, which pay coupons, which have got a maturity date, you can manage the risk. If you're invited to swap that for something which doesn't pay a coupon, which has a maturity of a century, effectively it's a perpetual zero coupon bond. Now, if you accept it willingly, it's not a default. But how do you think markets would take that, treasury markets?
again, once you attach terms and conditions to treasuries, nothing good happens. So the whole idea behind the Mar-a-Lago Accord, which suddenly all the kind of people around Trump are sort of, well, it wasn't my idea. I never spoke about it. What Mar-a-Lago Accord? It's like, no, the Mar-a-Lago Accord that you put in writing in November, this argument that you put forward. The idea of this, as you say, is, you split the world up into firm allies, squidgy allies, and enemies, effectively, and you sell treasuries to them on differential terms, depending on who they are, and that some of them, that if they want to have this so-called US security umbrella, and if they want lenient treatment on tariffs, then they have to scratch our back, right? They have to buy these century bonds or perpetual bonds. There's a number of issues here. One is, as we've just been discussing, the tariffs are on, they're off, they go up, they go down, they go up and up and up again. They can't stick to a line on policy for 10 days, let alone 100 years. So why would anyone in their right mind buy these things? Now, there might be a world in which someone, a massive bondholder like Japan, right? Japan holds $1.1 trillion worth of treasuries. They might say, fine, stick a couple of billion in these perps. It's no skin off my nose. I don't really care. And that could be claimed as a win by all sides. Fine. But I think the risk is that just anything like that undermines trust in treasuries that little bit further, and the market has demonstrated itself to be extremely allergic to that idea. You can't muck about with treasuries in this way. I think Martin Wolf here at the FT described it as a protection racket, and I'm quite sympathetic to that characterization. It's just no way to run the world's global reserve currency. There's so many issues with it. What if Russia were to buy some of these bonds? Then would the US step in as a security guarantor of Russia? Really? So they wouldn't be tradable, these securities. Everything about this plan is just like bananas. And everyone I speak to in the US Treasuries market is like, this is totally crazy and must never happen. Does that mean it won't happen? No, it could do. But nobody in mainstream finance wants any note of this to happen at all. And I do think it's pretty unlikely.
Okay. With everything we said, I'm getting pretty depressed. Can we try and make a bull case somehow for global assets?
Look, I can make a really strong bull case for Europe here. Check it out. FTSE's up 3% this year. The DAX is up 12% this year. This is speaking on the end of April. They've had a hammering, but they've recovered pretty well. And in dollar terms, they're doing incredibly well. So anyone who's holding unhedged US assets is getting fried overseas at the moment. So yeah, the bull case for US for me is very difficult to put forward with a straight face. But the bull case for Europe, you've got a continent that is working together. You've got a continent that must be thinking about more joint debt. It's prepared to do whatever it takes for defense and for the energy transition story. We've got some sort of peace/ceasefire-ish for Ukraine coming down the pipe, at least within the next couple of years. What's not to like about Europe? It's, they're looking at things like car factories that are laying idle because China is absolutely killing the electric vehicle market. They're doing a fantastic job on that. So Germany's thinking, well, why don't we turn these things into tank factories? Spain is having the same conversation about some of their auto facilities. So the bull case for Europe, I think, is stronger than it's been for years.
At the same time, building a load of tanks is not often bullish in the long term if you need to build a load of tanks.
There is some debate around, okay, what are the multipliers here? Say you get lots of fiscal spending put into defense. Does that just basically buy a bunch of tanks, or does it create a stronger economy overall? In the short term, I think it probably just builds a bunch of tanks. And actually, with more kind of high-end defense equipment, there will still be a reliance on bits from the US to make that technology work. But over the long term, I think there's a whole kind of ecosystem, there's a whole supply chain, there's a whole economic revitalization story that does stack up here. So that's why, you spending on just like spending on even housing or health or schools or whatever, market can be quite allergic to what it considers to be too much of that. But I don't think there's such a thing in the market's mind as too much defense spending in Europe when we've got clearly enemies to the east of us and the lack of a big ally now to the west. So I think it's very much a positive rather than negative story.
But how about things like reinvesting profits back into the business? If you look at the US, they've had much higher reinvestment rates. So if you look, over decades, you can see why they've had such big capital growth relative to Europe.
You can, but if you were running a US company right now, would you be looking to build a new factory somewhere? Would you be looking to hire a whole bunch of new people? Would you be looking to expand overseas? Companies can't do this when they are constantly at the end of a barrel from the president, where tariffs are on again and they're off again. And it's an incredibly difficult environment for corporate treasurers and chief executives to navigate in the States. And my hunch is that, corporate America, especially the kind of mom and pop businesses, the smaller businesses, they simply cannot cope with doubling the cost of their input goods and a bit more again from China. There's got to be some distress coming down the line here, whether that's redundancies or defaults or a combination. It's just hard to see the upside here.
Now, normally I'd expect to see the CEOs of large companies saying, this is crazy. This is going to hurt our business. This is going to crush our profits. And yet there's been absolute silence.
Mm-hmm.
The only place where we've really heard any kind of pushback has been in the earnings calls, which are now coming through for this quarter.
It's always the CFO saying it, not the CEO, right?
Yeah. Poor old CFOs.
Yeah.
Always get it in the neck. Yeah. So we did quite an interesting project at the FT about a week or 10 days ago, which is comparing stuff that big US executives said about Trump before the Liberation Day tariffs and stuff that they're saying after. There's definitely been a shift in tone, but the kind of, really big CEOs, your kind of Jamie Dimon, Mark Zuckerbergs of the world, they're treading a very delicate line. They know that this is a vengeful God and that, terrible things can happen to their businesses if they don't toe the line. But they have shifted the tone to some extent. And I think actually what's happening with universities in the States is an interesting pointer around where this might go. After a lot of faffing around and taking flack from the administration, they've finally banded together more and made more of a united front. Could that happen with corporate America? I mean, it could. But again, like we had a really interesting story a little while ago about the law firm Paul Weiss, which really got it in the neck from the Trump administration and effectively folded and said, fine, we'll do what you want.
Yeah.
And they got a lot of crap for this from the rest of the legal community and from the press and all the rest of it. But the guy who runs the firm was saying, tell me what choice I had here. It was either I do what the administration wants or the entire future of this law firm is at stake. On the careers of everybody who works for us, they are all on the line. So it's very easy for us to kind of be on the sidelines and say, well, you should never bend the knee, sort of thing. But in real life, it's very difficult to be that principled.
If we can make some kind of bull case for the US from here, would it be something like Trump's tactic is to go in big to begin with? That's his negotiating style. He'll step back and we'll end up with tariffs, global tariffs of like 5 or 10%, a little bit higher on China maybe. Maybe some countries like Canada will be excluded eventually. Who knows? And Trump will eventually get distracted by something else, whatever comes along, and he'll leave trade eventually and the world will just go on and we'll have a relief rally. Would that, I'm not saying that's what's going to happen. I don't believe that, but would that be the case?
You can make that argument, and particularly around the midterms. So by the time the midterm elections come round, it looks like you are going to have these empty shelves and people losing their jobs and small businesses defaulting. And that should, all things equal, swing Congress back towards the Democrats. And then, yeah, maybe he finds something else to be obsessed with. Greenland. Not also bad.
Yeah, that's not going to help.
That's not going to help. The thing with this notion that, don't worry, Trump will get bored of trade and he'll realize how hard it is he has been literally talking about this for 40 years.
Yeah.
If he believes anything about how the US should be run, it is high tariffs, low interest rates, low taxes. This has been an incredibly consistent line from him since he was, some real estate guy in New York. So is he going to change the habit of a lifetime, especially when he was specifically elected on this basis. So you see a lot of stuff kicking around online now about, people who run small businesses or whatever and saying, well, I didn't vote for this. This is going to kill my business. I can't pay these tariffs. I voted for Trump, but I didn't vote for this. And it's like, no, you did though. You literally did vote for this. This is very explicitly what you did vote for. He was very clear that this was what he was going to do.
He's the one president who's done what he said he was going to do in the campaign.
Exactly. So don't come crying to me. But it's very difficult for people to find that off-ramp. And whether that's, as individuals or whether that's as the president, can you really imagine him standing up and saying, guys, you know what? I think maybe I've overcooked this. Maybe I got the whole tariffs thing that I've been talking about for 40 years wrong. So there's been a big debate over the whole course of this year around, where is the pain threshold? Where is the Trump put, right? At what point do markets get so ugly that Trump says, okay, actually, I got this wrong? I think we've seen some elements of that with the step back recently and with the kind of volatility we've seen in the fixed income space in the bond market. But I think certainly what they're saying is, oh, well, we're here for the people. We're not here for markets. We're not here for Wall Street. We're here for Main Street. So we don't care how much stocks go down. Really? You cared about it when the last lot were in charge. How far do stocks have to fall to really convince him that he's got this wrong? It's a lot further than we are at now.
So let's say we come to May next year. Trump hasn't tried to oust Powell, but now he's going to nominate someone else. Mm-hmm. Presumably, they're going to be someone who very much favours a low interest rate policy. Mm. Do you think that would be taken as a negative by markets, or will they just be so relieved at that point that it won't be a big deal?
It depends who it is, and it depends where inflation is. And it depends whether the US is in full-blown recession at that point. So there's a lot of variables here. My point on the whole Powell debate is, look, he can't fire Powell. This is just not a thing he can legally do. But Powell's term is up in a year, as you say. Who does he replace him with? If it's a complete joker, then the market's not going to respond well to this. The other thing is there's nothing to stop him saying tomorrow who he wants this new Fed chair to be. And then you've got a shadow Fed chair who can sort of, chuck peanuts from the peanut gallery at whatever it is that Powell is doing. Oh, he's getting this wrong. Don't worry, everybody. As soon as I'm in office, I'm going to unravel this. This is a plausible scenario. So he doesn't even have to oust Powell for this to be a problem.
But does Trump understand that it's decided by committee and the Fed chair is not all powerful?
I mean, it is decided by committee, but the Fed chair role is a somewhat more powerful role than the equivalent one over in the UK. So the Fed chair gets their way pretty much. But even then, they are poking around for legal loopholes. That means that they could replace some other people at the Fed too. So this is an enormous risk to US assets. Markets have already made it quite clear that they don't like it one little bit.
Now, Katie Martin is a great expert at mixing humour and finance, and that's something we try to do as well in our own weekly market roundup. This is delivered free to your inbox every Friday, and if you want to learn more about that, just go to our website, pensioncraft.com/newsletter.
Okay, today's dumb question of the week. Is this a good time to be a financial journalist?
It's a dumb question, but it's a good question. On the one hand, yes, people read our stuff and they are very engaged with markets, and there's a lot going on. It's better than being bored. The flip side is, you can imagine from our point of view, Trump makes some big pronouncement about something really important like tariffs or the Fed or whatever it is. Do we put that on the front page of our newspaper? Or are we running the risk that by the time that paper is physically printed, he will have changed his mind again and then we'll look silly? So it's quite difficult. I think we are in quite a similar boat to asset managers. It's very difficult to know, is this noise? Is this real? Is this something I should really pay attention to? I feel like there's just a lot of wasted effort. We've all spent a lot of time and effort trying to unpack policy and what it all means, and then it's all chucked in the bin anyway. So I mean, yes, it's a good time, but it's also pretty exhausting.
It must be a great time to be a financial columnist.
Again, yes and no. I used to be a good little soldier. I would write my columns a couple of days in advance and I would file them to my editor and I'd say, look at me, I filed my copy earlier. Aren't I a good person? And now, you're writing everything on the fly. You have to, because everything is moving around so fast.
At least you're not wondering what to write about.
No, I would love to have something else to write about, though. It's Trump, 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 and I think we could all do with a break from Trump, but I just don't see it happening. I think this is our life now.
So thanks for joining us, Katie. It's been amazing to talk to you, and I love your stuff in the FT. It's great that you provide a bit of humour, which has made this really difficult period a bit more bearable.
If you don't laugh, you'll cry. So I just figure this is essential at this point.
Thanks so much.
Pleasure.
Thank you for joining us for many happy returns. Keep sending us your questions, no matter how dumb, at mhr@pensioncraft.com.
And do remember to check out pensioncraft.com for all the information about our membership, courses, and investment coaching options.
Many Happy Returns is a Pensioncraft production, co-hosted and executive produced by Romin Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.